Hello, this is Bill Scheid from Applied Finance Research, and in this video we're going to talk about the assumptions behind Monte Carlo simulations. Recently we've been discussing a lot the value of Monte Carlo simulations and also how to understand them and how to read them. So it's important in using a Monte Carlo simulator to be aware that there are some assumptions that are built in that are important for understanding what the results mean and understanding their limitations as well as their value. So the first assumption is that when we use a simulator, we assume that our backtest trades are an accurate and representative sample of system performance. So we want to be a little bit careful here. For example, if we ran a backtest only over a short period of time, or if we had a very small number of trades in our backtest, or if we ran it over, let's say, only one market type, then it may not be true that our backtest trades are indeed an accurate and representative sample of system performance. And of course, if they are not representative, then that means our results going forward won't match the results that come back from our simulations. So we want to make sure when we do a backtest that we get a large enough number of trades across a representative number of different market types, and that will actually be trading our system in those actual market types. The next assumption is that we've seen our worst case loss. My personal belief is that a limited sample from the past, that is a backtest, cannot capture all the possibilities of an unlimited future. And my belief is that future worst case losses will probably exceed those from the past. Now, if our future worst case losses are larger than our past worst case losses, that means that the drawdowns may be larger than what are reported in a Monte Carlo simulation. Of course, the worst case loss will be larger. Perhaps the length of time that our drawdowns last will be longer. So it's important to take our simulation results with a grain of salt in this area. Another assumption is that we're holding only one uncorrelated position at a time. Now, for our monthly systems, if we're just running one system like BMR21 or perhaps PMA-SPY, we're typically looking at our results, even if we're holding 2 or 3 or 4, we're typically thinking of our results as one uncorrelated position at a time, because we're turning our each monthly percent return into a trade. And that monthly percent return is usually the combined value of our multiple positions. So in reality, yes, we're holding more than one ETF and they're often correlated, but because of the way that we do the math and turn that monthly result into a single consolidated result, typically with monthly systems, we don't have to worry too much about this one. Now, if let's say we had a swing trading system and we were trading stocks that all were part of the Dow, then we might be holding more than one position and it might be highly correlated, in which case, again, we would have to take our simulation results with a grain of salt. Our gains might be larger than what the simulation shows, and our losses also might be larger than what the simulation shows. Also, in all of the research that I do, I tend to show my results using 95% confidence intervals with 1,000 Monte Carlo runs. This is a statistically sound approach. However, if you change the confidence intervals or the number of Monte Carlo runs, it does change the results of the simulation. So for example, if we went from 95% confidence to 90% confidence or 99% confidence, that's going to affect the results. And if we went from 1,000 runs to 500 runs or 2,000 runs, that would also change the results. And no matter what confidence intervals we use or no matter how many runs we do, improbable does not mean impossible. So Monte Carlo simulations give us some statistical probabilities, but not guarantees. So it's really important to remember that improbable does not mean impossible, and that there are some important assumptions built into our Monte Carlo simulation results. That will help us to not be surprised by our results in the future. And as Dr. Van Tharp says, the goal is to survive the worst case in the short term so we can stick around to achieve the expectancy in the long term. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.